I'm Brian Lloyd. I'm the founder and CEO of Painted Porch. And my background, when I was coming out of school was investment banking, private equity, and then ultimately worked at a hedge fund in New York, where I really dove into investments for the first time. At the same time, I was in the world as sort of like fast moving investment, mostly stocks, mostly in media, telecom, and internet companies. I was fascinated and have been for a long time with the work of Warren Buffett and Charlie Munger, and really getting into how things work and how you can reliably make good investments that make sense over the long run. So I just dove into that as a young person in finance and have loved the journey all the way. So I really nerd out about the discussions we have at the investment committee and how we can get to the bottom of like what we can reliably invest in with confidence, particularly in the long term for our clients and for ourselves.
Justin Valandrin, financial advisor here at Porch. In terms of me being nerdy, I really love getting into the weeds, exploring, how things are made, like ultimately how is that sausage made, not just that surface level answer. So really exploring all of the ins and outs, functionalities, and that sort of thing. So my background really is investment analysis and financial planning back in college. So really exploring, how do stocks and bonds work? How do the markets function? And then really got interested in the personal planning side of things of, what makes people tick and how do markets and people interact with one another. So that part has been fascinating, exploring, all the psychological aspects and how they all coincide with one another. So that's a little bit about me.
Yeah. Hi, everybody. I'm Katie Newell. I'm an advisor at Painted Porch in Santa Barbara. And I could not get away from finance. My parents are both investment lawyers. And so for a very young age, I feel like I knew too much, I would say, about the industry. I did a presentation, I think it was third grade, on what the SEC was. So it was just something that just was inherent. But I really became nerdy about how you can start early, and little things when it comes to investing can make a huge difference. And so I loved kind of digging into that. I went to school for finance and business management, and then worked in asset management at what I would say kind of smart beta type investment firm that also just loved to get into academia and learning about small cap and value and all these factors that could potentially outperform the market over time or have less of a volatility when the market went down. And that really was just super interesting to me. And so digging into that and also just educating people on that piece and so tying those things together. And so moving into wealth management and being an advisor, you can kind of tie all those things together. You can talk about the investments in detail if they want it, but you also can just walk through their goals and tie those investments as tools to make sure that they end up getting those goals. And so for me, it's about combining those together and making sure that our clients, reach those goals is what makes me super excited and wanting to nerd out and dig into all of that.
Hi, I'm Tim Linval. I'm an advisor at Painted Porch, and I've had the opportunity to be involved in finance my whole career, and I'm one of those that always knew that that's what I wanted to do. For me, it started out watching a show called Family Ties. And for those of you who remember, Michael J. Fox was a star in that show. He was very young at the time and one of the kids in the family, and he wore suits and had a briefcase and carried the Wall Street Journal at a very young age. And that started to inspire me. I thought that was very interesting, and knew that I wanted to do something. I didn't know what it was, but knew something with finance and markets and investments. And so from there, was able to work in institutional finance, different areas, always interested in where things start, the fundamentals. I've always been a fundamental analyst, whether it's talking about individual companies when I was investing in individual companies, or in the markets, just what's driving it, and studying that to really be able to explain what's truly behind a move in a stock price or why interest rates go up or down. It's always interested me. And with finance, there's so much involved where when companies need money, for example, to grow, they have agreements, and those agreements have legal documents, and wanting to dig into those and understand what the give and take is for companies deciding whether to raise money or not. Same thing with the economy, just understand what are the drivers, whether it's regulatory or market driven, and just watching those things, it's always been an interest to me.
I'll try not to do a Dana question and just do a question. So keep it to one. But I was actually more interested in how you guys approach kind of the data behind the behavior gap and just kind of what that has kind of meant to you because you guys have such a background, but kind of how you explain that um, and and really what it kind of means, I guess, at Painted Porch. And just feel free to jump in.
Yeah, I can say that I've definitely observed it over my career in different places. I managed large portfolios for large institutions and observed it within our own firm when I worked for those firms, and observed it just personally in my personal portfolio. There's a tendency to remember and talk about the investments that have done really well and kind of regret, but just not worry as much about the ones that didn't do as well, and never taking the time personally to look at, well, we'll combine those and what did that performance actually look like. And in reality, when you do that, it's worse than just investing in the market and staying diversified and disciplined. And so that's definitely on the personal side. Like I said, I've seen it on the institutional side as well, but I start at that level.
Yeah, behavioral finance, I feel like, is a huge piece of our job. And I think one of the reasons why I ended up going towards this career was actually when I was younger, watching the financial crisis and kind of seeing how people reacted to that. Because in theory, being successful in investments and growing wealth, it's pretty a simple process. If you keep investing over time and you don't take your money out and you don't spend more than you have, that you're going to be successful most likely. So it was always interesting to me, is why wouldn't that happen? But even in my own experience, it can be tough. It can be difficult if you see the market going up and everyone getting, quote unquote, wealthy because of investing in certain things. You want to be a part of that. Even me as a financial advisor, it's like, oh, should I be doing that? So it's I absolutely believe that the behavioral gap is a huge piece. And for us, it's just about letting people know that this exists and what type of things that happen in the market or cause people to react this way. And for us, just making things as simple as possible and having a long-term plan. And we, are partners with our clients to let them stick with that. That's kind of the biggest thing that I think we can do to help our clients be successful and not succumb to that.
Yeah, I would definitely agree with that. Like it's really easy to look at investing from a like acting as a robot perspective, but we're humans. We don't behave like A plus B equals C. There's all these other extraneous factors that come into play. And it's almost like I'm gonna use an analogy of like oil painting. Like the more you tinker with it, the worse it actually turns out versus like that one little stroke or just a tinker here and there, maybe via rebalancing to keep everything in line in terms of risk, um, works out really well. But I've seen the more you tinker with things, the more you try to chase returns or get into the next big fad or that fear of missing out, it really hurts returns ultimately in the long run. So it's how can you create safeguards or discipline strategies to make sure that you're not shooting yourself in the foot?
Yeah, I going back to, I think, just the basis of the behavior gap concept, which is Carl Richards' concept, right, is based on the Dalbar study. There's a longitudinal study on investor returns. And I've always hedged because, you can find articles where people pick apart the study as maybe being overstated or understated or having flaws with the way the research was done. But I agree with everyone else here that, like, in experience, we see it often. I've experienced it myself in my younger years. And so we know it's real. We don't know if it's exactly what the Dalbar study looks at, but what came up for me when you guys were talking was one of so many favorite quotes from Warren Buffett and Charlie Munger, but one from Charlie Munger, who's always a little saltier, right? Was, all this stuff we're talking about, and some of this is coming up a lot with the AI conversation in investing, and with more and more people out there using Chat GPT and Claude and Perplexity to get answers in this space. It always brings up for me that, like, there's not really anything new going on. There's not some like superior knowledge that we need. Munger has this great quote where it's like, hey, it's a few really simple principles, and just sticking to those simple principles. But that doesn't mean it's easy, because it's boring to stick with simple principles over the long time. It also doesn't mean, I think one of the things I'd love to hear everyone else also is, like, it also doesn't mean when we're managing other people's money that we're not being thoughtful or re-examining those principles constantly, but we re-examine those principles with the knowledge that it's really easy to want to do something clever at any given time. We get lots of pats on the back. Everyone wants it. If you get one win, you get to celebrate. But it only takes one or two real missteps to blow up decades of performance. And so I just find it like a fascinating area. It's a very difficult area. I don't know how everyone else feels. I do a lot better being a steward against the behavior gap for other people than I do for myself, which is one of the reasons I think a lot of people look for an advisor to help them. But yeah, I think the behavior gap is a real living issue, and until human beings change, I think it's going to be something that's always challenging to see through. You can think of all the conversations that come up when you think about it, because in principle, I think everyone would go like, yeah, no, I'll take the long-term strategy that works. But it's like, yesterday, okay, well, does that mean I'm in or out of SaaS and AI stocks? Like, is this time different? Which always comes up. Am I missing out? Or, if you're on the other side of the market, is it time to get all out of the market? I'm not a market timer, but man, it's scary. So should this be the time that I market time? Because it's really scary for me. So I'll stop there, but I feel like it's one of the dynamics that's so fun and challenging in our work, is to navigate that ourselves, but also help clients navigate it, because there's a lot of really powerful biases and forces behind why that behavior gap even exists.
Yeah, if you think about all the voices that we hear from the media or news or friends about great ideas or great themes, and you think, oh, that is very compelling, that's a very interesting idea, or industry or sector or theme, investment theme, and you think about all those that you read about, oh, that sounds interesting, or the other way, oh, that things are going to go back down, or the market's too high, it's going to go down. And a lot of that's coming from very smart people, and some of them are going to be right. And I think through how I think through that, and I agree with a lot of them. But why do we have to make it that complex? Because I have to get it exactly right. Whereas the simple concept is what works, and it's to keep things simple and to stay invested, diversified, rebalance over time, and you don't have to worry about having to filter through all these great ideas from very smart people. Because, as Brian said, if you get one or two wrong, that can really hinder the overall picture.
Yeah, I think it's interesting how the language we use, a lot of people in the market use for that exact thing, Tim, is passive, or um, not doing anything in relation to the market. And when you sit in the seat of having to make decisions around the investments, I would not call it doing nothing or passive. It takes a lot of effort to have the discipline to stay. It may seem like you just put your feet up and leave everything where it is. And certainly we hope our clients get to do that. But I think for us, it's like this constant, like, do we stay with what we're doing? Is this the right thing to do? Test it in every possible way. It's not easy to do nothing. At least the way the market says do nothing, right? It's a very active discipline to do nothing. I have a question, Dana. I don't want to cut anything off on this though. So I think it'd be really cool since we kind of have this open format. I just jotted down each of us to go around before we cross comment on anything, but for each of us, the way I ordered it is what's coming up most for you right now, whether that's in the world with clients internally, like what's one topic that's coming up that's one of the top ones that's coming up the most for you, and give a little about your experience with that topic, like what's going on for you as that comes up, but also how you feel like it, let's say if it's a client or a friend or family, how they're feeling and what's going on for them and how those two interact, if that makes any sense. And I'm gonna put it on Tim first, unless you need a little longer to process, and anyone can jump in, but
Processing. Yeah, it is coming up now, but and if I think about it, it's not really new in history, but it's fascinating the tension between fear of missing out or wanting more because the market, let's call it, is doing really well, or um, friends that are invested are doing really well, or at least talking about their good investments. But that fear of wanting and of missing out and wanting to get more aggressive on one hand, but on the other hand, realizing how strong the recent market has been and knowing that that can't continue forever, but it sure has continued for a long time. And so it's that on one hand, on the other hand, tension, and wanting to be able to capture both of those, protecting on the downside, but also participating when things are going well as they are. And so that's something I'm hearing a lot of, and it's challenging to navigate, and it does come down to just taking a step back and looking at what is it for, the why behind it, and what you really want to accomplish over a longer period of time, not next month or next day trade or something like that, but kind of just struggling through that and bringing it back to, okay, well, a 15% rate of return, we can talk about the risk because the risk that comes with that over multiple years of repeating that is very different than a risk experience of a normal type return of high single digits for a given portfolio. And so, and then what does that mean for you? That's increasing your net worth, it's increasing your portfolio, but at what cost, at what risk potentially? And do you need it? Do you want it? Is that driving? There's some decision behind that. Are goals changing? Or is it just an emotional response or a bias that's coming into play? And so working through that is something that's happening a lot right now.
Yeah, for me, I feel like there's been a lot of discussion on AI and large tech companies in the US. And is this a quote unquote bubble? When is this bubble going to burst? Is it going to burst? Is this what happened in the late 1990s and the early 2000s? Like, is there going to be a reckoning? So that, I mean, and it's a tough one because, we look at prices and, generally I feel like, personally markets generally work, they're good at pricing, but there's a lot of, we're people, we're not robots. And so if everyone gets excited about certain things and puts more money towards it, it's going to raise prices. And not every company that, this is a fairly new area here. So all these companies are going to try to make money in this space, and not all of them are going to make money in this space. And so, and there's this, general thought of reversion to the mean where, you can't have all these areas of the market or these specific ones going up forever. So what's going to make that go back to normal? It could be quick or it could be slower. So we don't have an answer for it. I don't have an answer for it, but I think it's generally about having a discussion with people about being diversified, which is one of my favorite words. It's just generally because you just never know what month, what year, certain areas of the market are going to outperform. I feel like personally, I've had conversations with even family members that are saying, oh, well, I'm invested in the S&P 500, so I'm diversified. Well, the S&P 500 is really not as diversified as what you would think. It's only US companies, it's only large companies, it's heavy in the tech world right now because it's based on market capitalization, which is just high in those areas. So having those discussions and say, well, what about investing outside the US? Bonds are a good thing to invest in as well if you're trying to diversify. So I think just kind of having those general discussions and because there's a lot of these words out there and people have made a lot of money investing in that type of investment over the last couple of years, but that just won't continue forever. And so just making sure they understand that is really, really key for us, I feel like.
Yeah, Tim and Katie hit it right on the head in terms of what's been coming up, at least for me personally, is like, why are we not taking on more risk, or the markets are continuing to climb higher and higher? But in the planning work, we showed, hey, you don't need to take on as much risk in stocks to capture that upside and for you to fully live the life that you intended. So that's something that always comes up of like, why are we not, putting the foot on the gas more versus taking a step back? Like, do we need to take on that risk? And then Katie hit it on the head too of, just invest in the S&P 500 and you're good. Like, yes, but what about US small caps? What about diversifying in international to capture all those other opportunities? Since year to date, international and last year has done extremely well comparative to the S&P 500, for example.
Yeah, I think it's interesting the concepts. I wanted to get like different stuff from all this, but there's so many themes that I think we're all dealing with that line up or touch each other. I mean, I feel like the last 4-6 weeks, couple months, there's been a lot of dispersion and there's been markets kind of like on and off. We've had people reach out to us about silver, gold. Silver went to 120, it dropped to 70. I mean, that crazy moves, Bitcoin's crazy moves the last 3 months, which, a lot of times are, in my experience, toward the end of cycles, people are looking for what assets where there's safety. With like Tim's point, there's safety, but also I'm going to make money, but it's safe somehow at the same time. And what came up for me was how fascinating it is. I think I want to put ourselves in that bucket too, but definitely with clients and friends and family, where this idea of conceptually sitting there and saying, going back to Tim's comment again of, hey, I want to make sure I don't lose money because I'm kind of scared the market's been up forever and I know it, but I want to totally participate in that up if it keeps going. And how we know the pain of a loss psychologically for most humans is much greater than the joy of a gain. But this is just me saying this. My experience in real life is that the anticipation of a loss is equal to the anticipation of a gain. So when we're sitting here going like, I can make money, I might lose money, it feels like everyone's thinking about it 50-50, right? Like if I lose money, I'm going to feel just as bad as I'm going to feel good if I make the money, especially when it's been, depending on how you look at it, 5 years or 15 years since we've had a real loss. And so it's like, oh, I think I'm thinking through the loss, but actually I'm not feeling what the loss is going to feel like. And so I think that's a challenge a lot of the time is when you're looking for the gain, that extra gain isn't actually going to feel as good as we think it's going to feel. The other thing I thought was this idea that Katie brought up of diversification and how, again, a lot of these things are like conceptually, yes, I'm in. Like I totally get diversification, but why do we own international stocks last year? I'm not sure why we own them. They haven't gone up for 5 years, and it's like, okay, actually 10 years. They have not outperformed for 10 years. And we had a really long run of large cap US stocks outperforming everything else. And so it became obvious, why don't we just own that? And then we can go through Katie's favorite color chart on like why you can't guess what's going to win next year. But when it's like 6 years in a row of large cap US stocks, it's also natural for a human to go, looks like that one. Like looks like that one's going to be the one to win forever. So I think it's getting dicey for people. I think people know it's getting dicey, but it's still hard to do the thing that comes back to discipline. Diversification means, and I say this a lot with clients, owning things intentionally that are not going to be the best performer. Like you are buying one of the losers for sure. We just don't know which one of the things we're buying is going to be the lowest performer in the next market. But we know it's going to look like, hey, why'd I put 10% of my money in that thing? It didn't perform. And it's there because who knew that that was going to be the thing not to perform or not. So it's like inherently unsatisfying in some way, certainly in the short term. And I always talk about like long-term hugs in that sense, right? Like we don't get market goes down, market's down 20%, we're down 10%, no hugs. We're down 10%. That sucks. Market's up 20%, we're up 10%, no hugs, because the market's up 20, we're only up 10. It's not till like 7, 8, 9, 10 years that we get the hugs and the high fives and the breakthroughs. So I feel like this is one of those times where things are getting shaken up, and maybe there's a real kind of reorganization of the market, and some of those things will really show, but it's difficult for people. It's difficult for us to navigate at the moment.
Yeah, Brian, I really liked your point on the fear of loss, kind of outweighing, I think because one of the main things is it's all about time too. I feel like people will say, okay, well, I'm going to wait until the market, goes down, or, because I don't want to put my money in, and that could be the last 10 years. But if the market does go down, let's say you're a 30-year-old, and this money is going to be for retirement, the market is really good at coming back. If you really zoom out, you can see over time it goes up. So yes, if you're wanting to buy a home, next year, yes, we should not probably invest that in the market right now because we don't know what's going to happen next. But if this is going to be money that you need 30, 40 years down the line, just getting invested and having that compounding start working for you over time is a lot more important. And so showing those, those charts that we have that kind of just show, even with the financial crisis, the market was back in about 5 years. That can kind of help kind of put that in context, because you never want fear to kind of change the best decision for you. But it's just important to kind of zoom out and know that investing is usually for the long term.
I have one more if no one has something. It's somewhat similar, but maybe just articulating. You guys had some good concepts, and then Katie even kind of pulled the like, hey, compounding long term. But on the flip side, like, what if I just retired? Or what is this tool rebalancing? Like maybe just zooming in a little bit more on, the discipline of what we do. Just pulling that out. If you get what I get at. So like, yeah, if you're a 30-year-old, you like just get invested. I got your answer there. But like what if it actually hurts for real? Or some of the other things that we do to help.
I don't know exactly what you're hitting on, but I think one of the most valuable things we do, and one of the most valuable things about having an advisor, if you buy into this concept of rebalancing, is to get it out of your own hands, because I think it's the place that's the easiest to cheat yourself when you do it yourself, either to let something run if it's going up or not to step in when it's going down. And I think when we talk about it conceptually, sometimes it's hard. We're so programmed by CNBC or the news flow or whatever to think in absolutes, like, okay, is this the bottom of the market? Am I into the market? Am I out of the market? We've even had clients come in and go, hey, they're going to be a 60-40 portfolio, 60% stocks, 40% bonds. And they have that same thing Katie brought up, which is like, well, I don't know if I should go into the market right now. Well, you're only going to the market 60%, even if you put it all in, like it's fixed income and equity. And when people say the market, I assume they mean stock market generally when they talk like that. And so if the market was down 10% or even 3 or 4% on a given day, it can feel really violent. And if your portfolio says, hey, it's time to rebalance, whatever thresholds you set, and we have the ones we do, it's really easy for an individual working on their own to go, ooh, I don't know if I want to step in front of this train. This train might be going down forever. And inevitably, the way crowds work is as soon as everyone feels that no one's buying the market, that is the bottom. But rebalancing doesn't require you to know the bottom. It just requires you to have discipline, buy a little if it's going down, sell a little if it's been going up, to get back to the targets. And there's something really counterintuitive about that, especially in practice. Again, going back to the last conversation, as we tell clients a lot, we're going to be buying the thing that's performed the least from an asset class perspective. Individual investment, maybe, maybe not. We're looking at that at the investment committee level. But from an asset class, if small cap stocks have underperformed for 2 or 3 years, that's what we've been buying. If large cap US stocks have outperformed for 10 years, that's what we've been selling along the way. We got that question about Berkshire Hathaway quite a bit lately, where Warren Buffett's retired and we own a good amount of Berkshire Hathaway, and everyone's like, well, are you trimming it? It's like, well, we've been trimming it for 3 years because it's been one of the best performers. Like when we go and rebalance, it's outsized, so we trim it. So our exposure is not compounding and getting bigger and bigger in the winners, and it's not abandoning the losers. We're sort of committing, again, from an asset class perspective. It takes a while for people to get that concept. And I think even with someone mentioned the performance of international stocks recently, I think people start to go, ooh, you guys are really smart. You got international stocks. No, we're not. We're always in international stocks. Oh, you bought some when they underperformed for 3 years. Yeah, because that's our job. It's discipline. And so I think that takes some time, even at our investment committee level, looking at really long range returns. If you narrow the lens and you say the last 5 years, let's never own international stocks. The last 3 years, let's never own small cap stocks. But if you open the lens and go, what does it look like long term? It's a very different answer.
And for clients, I think that have, any fear of getting into the market, there's a lot of folks that have come into us and they say, well, I have all this cash, I want to get invested, but I'm in retirement, or this is, everything I have. We have a process, that we call kind of ramping the portfolio. There's a process of slowly moving into the asset allocation that they have decided, we've decided together that they're comfortable with from a risk perspective. But we don't need to do that in one day. We can do it over time with what they're comfortable with. And the great point of that is you're buying into the market at different, it could be up, 1 month, down 1 month. And so you have a more flat process of getting invested, especially with just how it is today, with the market can kind of go up like crazy and come down the next day. So that's a process that I feel like for clients that may be more hesitant to move into the market, or maybe in a more risky position where if they get it all invested and then the market crashes the next day, could really hurt them. We can have a slow process of moving them into the asset allocation that they feel like is best for them long term.
If you look at those benefits of dollar cost averaging that Katie was alluding to versus a lump sum, like the benefits are pretty marginal in the grand scheme of things. So it's really time in the market versus timing the market. A really big key of not getting bent out of shape over, well, markets are at all-time highs, and then if you look at those studies, like if you invested or keep investing, you're actually better off versus trying to wait for that opportune moment of oh, here's the low, I'm going to get in right here. So I really think that's impactful. Just getting your money in the market is probably one of the most important things. And then touching on the whole diversification debate, I think it's really impactful of you're always going to be apologizing all the time of owning things that aren't performing as well versus things that are performing as well. It's like, why don't you go all in stock A versus stock B? And that's just not how things work in the long term. And then keeping that discipline of rebalancing, making sure that the portfolios aren't quote unquote drifting away from their intended targets, or exposing yourself to more risk than is necessary. And then if you were doing it yourself and you're like, wow, this one's been doing really, really well. Like, why would I sell that winner and then buy something that hasn't been doing as well? And getting into that behavioral gap that we were, referencing earlier as well, it really can hurt. That single decision in that point in time can really hurt returns. So it's really having that disciplined, level-headed approach. So where it's like, hey, stock A is, past its target, we should trim that or sell it, and then buy stock B that's maybe underperforming and under target, so that we're keeping everything in line with those risk parameters. So we're not exposing ourselves to excessive downside risk than our target portfolio.